I'm good.
Doing better. JPY didn't plummet the way it did.
So you took I'm taking it you took a buy position.
No, it's funny. It's ironic because when you put in the group yesterday, AUDJPY, I was already in a sell for CHFJPY based on 10 PND. And then I guess with the yen weakening all yesterday and this morning still, it's just been skyrocketing. So
yeah, exactly. And as you can see now, can you guys see my screen?
yeah.
All right, cool, perfect. And you guys hear me okay, right?
Yeah.
Excellent. All right, so, this is just going to be a quick recap. I really want to be able to do this, as often as possible. I know we're not going to be able to do this, every single day, but just to be able to have these recaps of why we took the trade that we took, what did we see in the market, and things that, we see that cause the move to go against us will help us improve and help us be able to see different things in the market when we're looking and, getting ready to place a sell order, or ready to place a buy order. So give me a quick second. Let me just mute everyone. If you're on right now, can you just mute yourself? There's a little bit of feedback. And just whenever you're talking, you can unmute yourself to talk. Perfect. So just kind of looking at, AUDJPY. So as you can see here, if you're looking at my chart, you'll see a few things. You'll see definitely all these different resistance and support levels, as well as these displays right here. So what I like to do when I'm first charting or whatnot, I do a top-down analysis. So basically, I'll come here and I'll switch it from the hour time frames, and I'll just look at the weekly, just to get a gauge of where price is overall in the market and just to see the overall trend. So as I'm looking at this here, where price is, I was seeing a downtrend. I was seeing price was just continuously downtrending. So, I was in a sell bias. Just all my positions I wanted to take were sell based around the resistance level. So just kind of looking at that there, what I like to do is instead of just looking at the candlesticks, I'll switch it from candles and then I'll look at the line chart. Now the line chart kind of gives me a better picture of where price went, so I can easily hit these levels. So I can go ahead and put a horizontal line here as a support level, another horizontal line here or up here as another support level. Now, when you see these asterisks beside these levels, that means that it's a key level. So that means that price was once underneath it, and that level acted as resistance, and then price broke above it, and now price is acting as support. So when you have price that's acting as support, a level acting as support and resistance, you have what is called a key level. And these key levels, you need to watch them very carefully because price typically does the same exact thing over and over and over again. And this is probably the reason why, Vic is so effective with his trades when it comes to GBP USD, because he sees these levels and he understands, these key levels. So when you place trades at these levels, 9 times out of 10, it runs in your favor. So after I look at this weekly, and also before I keep going on, if you guys do have questions as I'm going along, feel free to, just kind of blurt them out, and I'll answer them as we go through. So let's switch back to candles. So after I chart them, I'll switch them back to candles, and then I'll just kind of look at that line and see how it reacted, how price reacted to that line. So this line, of course, was based off of this area here because this is where price was. So I put a support line there, and I kind of just look back. You had price kind of cut through it, but it hovered around that level. It didn't go too far away from it. Same thing here. Price cut through, but then it squeezed back in. Same thing. Price cut through, squeezed back in, cut through, squeezed back in. And price is just really hovering at this level. It stops at this level. It stops. And when you're looking at a weekly time frame, you're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles, right? 11 candles, that's a total of about 77 days. That's a lot of data per candle. Per candle, that's so much data. So when you see these levels and you see candles getting stuck on a weekly time frame, you want to pay close attention to them because this is a lot of data that's telling you. So after I chart all my weeklies, and the color coordination doesn't really matter, as long as you have them displayed or you actually have them marked out as weekly, hourly, daily, you'll be good to go. So you can really use whatever color you want to. And then I'll just go to the daily. Same situation. Switch it from candle to the line chart and just look at how price is bouncing off the daily. My dailies are these magenta colors. So as you see here, I got a daily right there because price is kind of bouncing around this area. It also stopped around this area. Let's zoom back a little bit further. Stopped at this area. You know, you see that right there. You see all of this happening here. So this is another key level for me. Now, if you don't see a key level above on a daily, don't force it. Don't force it. Don't even draw anything about it, because if it's not there, it's just not there. You can't do nothing about it. And my dog is acting a fool. Chill out. So then we bounce down. So we look at the candles. Make sure that, you know, price is respecting that level. So we see it here. Price is respecting it. We come back this way. Continue to look at the magenta. Price is still respecting it. Still respecting it. So you see here, price was once resistance. It got to this point, broke above it. Now price is respecting it as support. Key level, very key. All right. So then we look at let's look at the 4 hour. All right, same situation. Switch it to line chart. So we see here, price is respecting that 4 hour level. Boom, boom. Let's look back a little bit further. See what we see. Price is respecting the level. Boom, boom. It's acting as support. Comes below, it acts as resistance. So we know that these levels are key levels. This is a key level, so let me go ahead and add an asterisk, right? And then we just look at the candles, see what the candles are doing. Is there a lot of wicks? Are we seeing wicks at these levels? Boom, we're seeing wicks. We're seeing all these wicks once it gets to these like key levels. So then you just go down. So at the 4 hour, this is where I like to actually look at the prevailing trend. And you want to pay close attention to this. When you're trading, they always say, you know, the more successful traders always look at the prevailing trend if you're looking to take, you know, a position. So when you're looking at a trend, and this is where I messed up, because I knew the prevailing trend was uptrend. Because as you can see, we got a low, we got a higher high, higher low, higher high, higher low, and prices is continuously making higher lows, right? And now you have this ascending triangle right in this area. But I was looking at this level from an hour time frame and not considering the 4 hour time frame as far as, price is going up. So we should be, you know, buy bias. I should be looking to take a buy position since price is hovering right at this level, you know, and it's not breaking above it, or it's not just dropping below. It's just hovering at this level. So I should have a bias of buying. But me, you know, jumping the gun too soon and not being patient and waiting for the actual trend to break out in the favor, you know, I jumped in way too soon. So we know that price is, you know, it's uptrending from wick up to this point here. So I look at from point to the second point and then into the future. It doesn't matter, you know, if it's going through this, going through this, going through this and that. Just from one point to the next point into the future. If price was doing this and then eventually it started going up higher, I would make another trend line going a steeper trend line, right? So from this point forward, then we kind of bounce down. We know that it's an uptrend. We look at the hour time frame. The hour time frame is going to give you more data. So as you're looking at the prevailing trend, what do we see? We see the higher lows. We see the higher highs. Price is pretty much moving in a channel if you look at it. See what I'm saying? So you got price up there, price down here. It's moving in this, you know, ascending channel. This should be a clear, you know, indication that, yo, price is going to continue to go up. Now, if price did this, it hovered in this area, boom, 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 and then cut through and came down here. Now we have a new trend to follow. Price market structure was broken because the last higher low was here. It was right in this area. So these were the last higher lows right in this area. Now, if price broke and came down here, we would look to take a position once price got down here and then retested the line. And at that retest, we would look for some type of price action, bearish engulfing, evening star, something along the lines of that, for it to tell us that it's a clear indication that price is coming down here, right? But instead, what I did was I anticipated the move way too soon. I knew that price was going to do something very soon because I was watching this back here. I saw this on April 10th. I saw this move, boom, and I saw it come down. And then it respected this moving average. So this moving average is the 200-day moving average. It just kind of gives you a historical outlook of the past 200 days of where price is. Price came, touched it. It never broke through it. And I should have knew that, look, price, if it didn't break, it's still uptrend bias. Then price came back up to this area. But you see what happened here was price was moving in this channel. It was moving in this channel. And me being, just kind of thinking too far ahead, I was like the first, movement, first radical movement, whether it's bullish or bearish, I'm being biased in that manner. So I saw this candle right here, bearish engulfing. You got this small green one followed by this large red one, bearish engulfing. Instead of me waiting for this candle to close and then waiting for this candle to confirm price is moving down, I took the position here. Or better yet, I looked at the 30-minute and saw what price was doing. So then I saw that, okay, price had dipped, right? Saw 30, and I saw these candles here. I saw price was dipping. So I was like, let's go ahead and take an entry. So that's when I kind of gave that number. It was, I believe it was like 79.475, something along the lines of that. I was waiting for that little retrace back up to like this area right here, and I was looking for like a downward move. It never did it. The reason why I set the stop loss, somewhere around, actually we were looking right here. I set the stop loss somewhere around, it was like 79.595 because this was the top of that line. And I recommend everyone, and I stress this so much, that you use stop losses. Now I understand that, price won't move in your favor sometimes, and it'll move against you, 20, 30 pips before actually following the trend. But when you have stuff like this that happens, you lose so much more money for no reason because we want to just wait it out. There's no need to wait it out. The thing is, if your risk to reward is 2 to 1, you're always going to be in the green from a long-term perspective. Look at it like casinos. Casinos only win, I think their win ratio, it's so low. It's like 11% or something like that. But overall, they win more hands than they lose, or something along the lines of their risk to reward is set so strategic that they're still able to make billions of dollars a year. So we have to, kind of gauge that idea and use that same idea, especially when it comes to stop losses. Because I hate that, a few of you guys were losing a lot of money because of this uptrend. Now, I know you guys are saying, oh, it's going to come back down. Yes, it will. But we don't know that, price is going to come down 100%. From this point to this point, you look at, the Fibonacci, a retracement level at 38 is here. A retracement level at 61 is here. 50 is here. We took an entry point here. So we can't just, automatically assume that price is just going to come all the way back down to 100%, break the 100%, break the uptrend line, retest the trend line, and then come down and then break the daily. Price ain't going to do that all in a day's time frame, 2 days time frame. It's going to take time for that. So that's the reason why I said, to set that stop loss at this yellow line up here. It was important that we did that. So just kind of going back to the 1 hour. And before I move on, do any of you guys have any questions?
No, I'm following you.
Okay, solid. So just kind of gauging it now, going back to the 1 hour, now that we can look at it, in hindsight and see the move that took place, this candle wasn't the candle that we should have been looking at the entry. It should have been the next candle. We should have been looking at, okay, once this candle opens, let's give it 10, 15 minutes to see what direction it moves. Because if this was an impulse move, when the market moves, you have impulse and corrective moves. An impulse move is in the prevailing trend. It's the direction the trend is moving. So this would be considered an impulse move. This is a corrective move. The corrective move is always smaller than the impulse move. It's typically on the Fibonacci, it's anywhere between 38, 50, and 61. It's a strong trend if it's at a 38. It's a mediocre trend if it's 50, and then the trend is a bit weaker if it's at 61. So we draw Fibonacci from here to here. Boom, it came down to 61, letting us know that the trend was a bit weak. What happened? It just hovered in this area. So I was looking at that and I was like, the trend is weak. So I'm assuming that price is going to come back down. If we look at an area like here, this looks like a 38. Just about 50. You see what I'm saying? So like, it's letting you know that the trends are, it's still strong. Same thing here. Price came, hovered at the 23.6. It couldn't even break past the 38.2, letting us know that the trend is still, it's still buy bias. It's still in an uptrend. So when you're looking at this and you're using these Fibonacci's, this will help you. Now, when I was here, you see, I took the Fibonacci tool and I drew it from I just used this one red candle, which was a bad idea. I shouldn't have done it. Use the high of this red candle to the low of this red candle. And I waited. I was like, okay, the high of that candle to the low of that candle is here. Let's wait for a 38 retracement. We saw that retracement. Price started to come back down. Then we saw the 50. Price was still kind of coming back down. It was still at the 50. Price was still, still trying to nudge and come down. We were seeing all these upper wicks letting us know that people are trying to sell this off. They're trying to sell it off. So I was, sell bias. I mean, that kind of gave you the clear indication. But we should have waited for a clear move. This wasn't a clear move now that I look at it. Now in the future, I know exactly what I'm looking for. I'm not looking for that. I'm looking for this. This is what we're looking for. We're looking for this type of move. We're looking for a clear breakout above the channel and then a retest. So here, we could have gauged it from here to about, I would say about here, because price was at its all-time highs on this candle, right? So we put the Fibonacci here, or even we could have gauged right here, that last green candle, because that was the last green candle, and then we had a red candle. We could have gauged there, and it would have told us that at 23 is where price got stuck. Price never broke below it. You see this wick, but it came right back above it, snapped back above it, and then the next candle never broke below it. So this candle here, we could have easily took an entry right above this last wick, And then from this last wick, this pair right here doesn't really move that much, but you're looking at 61 pips in 4 hours of upside. Now, if we're not basing off of that and we're just looking at these two levels, this is where realistically you would want to take, profits at these levels. This is where the harmonic scanner gets their numbers off of too. You guys wanted to know their TP levels. So from here to about here, it's about 14 pips, risking about 13 on the downside. That's a 1-to-1 risk to reward ratio. It's not a solid trade when you look at it. But if you were to just gauge it, and see that, okay, this candle is still bullish. It's still bullish. It's not coming down. It's still bullish. And just wait it. And then once you saw this, you just close your position around here at the bottom of this wick or whatever the case may be, if that was the case. It would have been anywhere from 20 to 30 pips. And you could just, use your own analysis of, where price is and how it's moving, and if, you want to continue to move in its favor. Once it broke out here and then it kind of came back to retest this level, from this point forward, you're in the green. You could have moved the stop loss above this area to break even or even take a little bit of profit. Or you could have just rode it out. You know that there's going to be a few green candles to follow. Now we have this up here. So what would I do? I would take Fibonacci, draw from the lowest point to the highest point, right? And I would just wait. Don't take no entries right here. Just wait. We see that, all right, price is at another resistance level, this 4 hour. The 4 hour lets us know that this is a resistance, and price is coming back down. So what should we expect? Price to either come down to the 23, so we could draw a quick zone. Take this, put that there. All right. Colorway. So we got a zone right here. This is one zone. Boom. 38.2. It's another zone. We got the 50, that's one zone. And then we also have 61.8, that's another zone. So these are the zones, the levels that we're looking at. And you could mark them up, text, whatever you want to do, you know, whatever makes sense to you. If it makes sense to just kind of mark them up to just let you know if the Fibonacci is, you know, too distracting, you could do so. We don't have to do the 50 because we know the 50 is in between 0.618. Right, so we know these levels right here. So now all we do, we just wait. If you see that price goes even higher, what you do, you just take the Fibonacci and then draw price a bit higher. And then the levels are gonna change a bit. And all you do is just move the levels up. Don't bite, don't move until you see price get stuck in one of these areas. And then you see some type of, you know, bullish or bearish move out of that trend. And then you take the retest. When you see that retest, that's when you take the entry. Because this right here, just moving on this first candle wasn't sufficient enough. Because it would have came down and you would have been in the red from up here to about down here, which is about 20 pips. You know, now it would have came back in your favor, you know, 7 hours later. But if you're impatient, you know, who's waiting 7 hours for it to just go back to break even? So you would want to wait till it comes back in the zone and then you see the actual prevailing trend. It's following this uptrend. People right now that are in this position should be buy bias until you see that the higher lows are broken and you start to see lower highs being formed. That's when you can say, okay, we're no longer, you know, in the uptrend. This right here, this higher low was broken. You could have took an entry about right here. This would have been a solid entry. If you look right here, this was the last high. Price was broken. What did price do? It came below it, retested it, and then dropped. This dropped 28 pips, you know, 30 pips in 11 hours. The retrace, 4 pips. Couldn't even came up here or gauge 10 pips, whatever the case may be, to do like a 2-to-1 risk to reward ratio. So that's where, you know, this is where I messed up at. You know, when I made the call, this is where I made a mistake of anticipating the move too soon. I should have waited for more of a confirmation or more of a strong trend out of this channel. This wasn't strong enough because now that I look at it in hindsight, it's still within the channel. What we call this here, we call this basically range expansion and range contraction. So when price is hovering in this channel and then it kind of opens the channel up a bit, that's range expansion. Now, once it starts to consolidate and makes an even smaller channel from like this would be considered range contraction because it's making the range a bit smaller. This is when you know, right here, all that's happening, banks are just taking position. They're accumulating size to take their position to the upside or the downside. Now that we know that this level is key, we can really draw this into the future as a key level, you know, a key zone to watch for, because we know that price is hovering in this area. And if you look at this number here, 79,600, it's like from a psychological standpoint, this is a key level. This is a key area that traders make. The 79,600, 79,400, 200, 79 even. You know, these are like levels that people they tend to accumulate size. Like as you can see here, you know, accumulating size, price stops about right here. Accumulating size, price never breaks below this. At this point, price shoots out above it. Now we're up here, you know, and we're trying to see where price is going to go. Will it stop at 500, 80.500, which is pretty much this 4-hour line that I just drew right here? I didn't even look at this. I knew that this area was key based off of price. So we'll just watch it. We'll see what happens up at the peak of this. You know, it might be today, it may be next week. And we'll just see how price respects these levels, whether it goes to the 23.6 and stops, whether it goes to the 38.2, the 50, the 61, or if it drops below the 61, then we should be looking to take sell positions. So if it drops below 61, wait for the retrace up, look for the lower high, and then look for some type of bearish price action signal as far as like a bearish engulfing, evening star, a candlestick, a bearish variation where it's like one green candle followed by 3 red candles. Look for something like that to take a sell position. But like I said, I don't think this is going to happen today. Like I mentioned before, Fridays is usually when people are selling off their positions, take their profits, and then they go splurge on the weekends. I know that's how it is in the stock market. I would do it every week, making money in the stock market, just close my positions, go spend money. But from this point, do you guys have any questions?
No, but could you do like a little bit more of this, like on the tech call that you're gonna do on Sunday, like a little bit more in depth of?
Yeah. So what I'm gonna do is basically it's gonna be same thing of this, just chart analysis, marking up charts, how how I look at my top down analysis from like a weekly standpoint. Exactly what I just gave you. Like I gave you guys like a brief overview of how I chart. How I look at charts. Like for instance, let me just open this up and look at another pair. All right, let's look at NZD/USD real quick. So looking at NZD/USD, basically how I'm charting it. Like right now, it's a naked chart. There's nothing on here. We see where price is. We see all of these just different lines, but we know nothing about what's going on here. So basically, I'm just from start to finish, I'm looking for areas of key areas on a weekly and daily. Like what are the key areas? Like where has price been support and resistance? And I can see long term, this is May 2005, right? June 2010, August 2015, May 2017, November 2017. Now we got, April, March 2019. This level right here is key. This is a key level. Asterisk weekly, because I'm looking at the weekly chart. Now, just come here, look at the candlesticks. Look how price is playing around this level. See what happens. Price came, drops. Price came, uptrend. Price came, uptrend. Price broke through it, retested, dropped. And then you want to look at like how big are these movements? Like this movement, that's 600 pips in 50 days, We're not holding it that whole time, but we want to see like is price just, touching it and then coming back to it? Well, for like 200 pips, it's not solid. We're looking for like big movements. So like price came here, touched it, went up, 1,300 pips. All right. Price came to it right here, went up another 2,000 pips. Like we're looking for like solid movements. Like price came below it, retested, dropped. This drop, 500 pips in 21 days. We're looking for things like that in the market. So as we find it, and as you can see, check this out. Price right now is near that key level. Price came, touched it, now it's uptrending. And then we'll just do that. We'll just look at the daily, same situation. Come to the line charts and just look at it. All right, like what's happening? Like is this a level right here? I would say yes. Why? Because price touched it, tapped it. It's not breaking above it. It's hovering along it. Let's look at the past. What do we have? Prices hovering, prices tapping, not moving around, sitting right above it, respecting that level. It's respecting it here, respecting here. See, tapping it. So we're seeing a lot of that. So when we see that in the market, we gotta mark these levels, and we gotta keep note of these levels with asterisks to let you know that, this is a key level. This isn't just a support or resistance. This is like a level where price comes to this area and then it does something drastic, whether it's an uptrend or a downtrend. But as you can see from like here to here, in like 3 days, that's 100 pips on an NZD US dollar. You're getting 100 pip moves on like GBP pairs. These NZD pairs, they don't really move that much. If you look at a daily candle will let you know how many pips, they really move in a day. And you're looking at about like 54 pips. I use a tool called, see if I can go to it real quick. Forex validity calculator. Then that word screws me up. Volatility calculator, right? And I just look at just a 2-week bias, and I just calculate it. Now, what this does right here, it lets you know for the past 2 weeks which pairs moved and how many pips they move. As you can see, NZD USD typically moves 40 pips a day. The reason why Vic plays around with the GBP pairs is because they move large movements, very large movements. 144 pips, 131 pips, 98 pips, 106 pips, 135 pips, 88 pips in a day. In one day, that's the movements that are taking place in a day. And then you got other pairs, your odd pairs, 50 pips, BTC, USD, 2,000 pips in a day. This is unrealistic, and I wouldn't recommend anyone playing with these until you understand how cryptocurrency works as well as how USD work. Same thing for like these exotic pairs, like ZARs. Let me see if there's anything dealing with ZAR. Yeah, USD ZAR, like a ZAR 1,500 pips. This is ridiculous. You know what I mean? Like these type of moves are just completely ridiculous. So when you look at this kind of gauges and lets you know, all right, what do I want to trade? Like, what am I comfortable achieving? Is it 40 pips? Is it 20 pips a day? Is it 100 pips a day? Is that what I want? Then you kind of look here and you just gauge like, all right, what's moving in that manner? Like Euro AUD is moving 80 pips. If I catch 20 pips of that, I'm solid. And I know that this isn't moving so far against me, and you just look at it on the chart. Let's see, what is that? Euro CAD. You see where price is, like you just look at it from a weekly, do your top down analysis to the daily. As we can see, like first thing that I see this. I see a downtrend as well as a bottom. What does this let me know? We have a descending triangle taking place. But let's look at the overall picture of the market. So from a weekly standpoint, if you draw a line from here to this level into the future, price is nowhere near it, so we don't got to worry about it. Because from here to here, that's about 400 pips. We know that this moves 70 pips a day. It's not near that level. So we'll go down to the daily. We'll see what the daily chart is doing. Same situation. We see that prices, it's coming down to this level, bouncing back above, acting as support. Price came down here, it tapped it, now it's on an uptrend. So what we're looking for future price move. We won't touch this here. Why? Because it's in between. We don't really know. I mean, we could use this double top, as a gauge and say, all right, once price comes here, I'm gonna take a sell position if I see some type of bearish movement. This is bearish. It's bearish engulfing, followed by a continuation of the trend. Price came back and retested it, but we see the continuation of the trend. And then from this point, let's say you took a position here when you saw that price is dropping from about right here. 3-day movement, 138 pips. You just held it until it got down, let's say you were looking to sell at this line. It's about 227 pips. It never got down there, but you could have closed your position once you started to see this. You made 117 pips, in an 8-day span. Now that's a long-term bias, looking at a whole week of holding one pair. Well, let's say you're taking, a 0.2 position or a 0.1 position. You're making like $100+ bucks in 8 days, and you don't really got to take that big of a position on this. Now, same thing goes forward. If we see price comes up here and then we see price break above, then we want to look for a retest of this area to act as support. And then once we see some type of bullish confirmation, that's when we could take some type of position right here with a stop loss below it, whether that's 10 pips, 20 pips, You know, if we're taking like a 20 pip stop loss, we could do so. But we're looking at it daily. So let's jump down to like a 4 hour. As we can see, prices making higher highs, higher lows, higher highs, higher lows, higher highs. So it's uptrend bias. You know, prices is uptrending nicely. So this is pretty much what, you know, I'm gonna go over on Sunday to kind of just, you know, gauge a few charts. I'm gonna look at the charts that I have in my on my watch list. So I'm looking at, you know, I have these like 9 pairs that I pretty much watch or whatnot. And just if I see anything that's close to a key level, I'll put one of these little red tabs next to it. And I know when I wake up in the morning around 4 or 5 a.m., you know, I'll just quickly go to those charts, see where price is at, you know, and see if it's at a level where I could take a sell position or if I could take a buy position. And I'll just watch it. I'll just watch to see what's going on. All right. All right, you guys. Do you have any more questions? Take that as a no. All right, so we'll conclude, you know, this recap. Like I mentioned, it was the AUDJPY recap. You know, it is recorded, so you guys will have it for future references if you want to just kind of reference back to it to see, you know, what happened with AUD and, you know, some of the things that I mentioned. But I appreciate each and every one of you guys for hopping on, you know, this morning and taking the time out of your day to do this.
All right, thank you.
Yeah, no problem, no problem. But
Appreciate you, bro.
Yeah, solid, no problem. Well, you guys have a great weekend. I'll see you guys in the chat room. We'll talk some more. You know, and if you guys do see anything, you know, I recommend, you know, I always encourage self-sufficiency. You know, don't be afraid to call something out, you know, or even just take a quick trade on your own, because that's how you eat. You know, like Vic giving signals, or, you know, all these other individuals passing out signals and, you know, taking those signals. That's one way to make money in this. But if you really want to become like very successful and profitable at this, it's learning how to just, you know, take these trades on your own, you know, and just using your own bias. It's okay to be wrong. Like, honestly, I have friends that trade stocks, and one buddy of mine who he's 42% right. So 58% of the time he's wrong, but his risk to reward is like 3-to-1. He doesn't lose trades. It's like 3-to-1, 4-to-1. He doesn't, like, he's green. He's been green for the past like year, you know. And it's crazy to know that you can lose more than you win and you still come out profitable. It's that risk to reward ratio that you use. Like, as long as you're setting your stop losses correctly and you're letting your winners run, you know, whether that's a 2-to-1 ratio, 3-to-1, 4-to-1, 5-to-1, 6-to-1, whatever it may be, it washes out losses. You have 2-3 losses and you have one win that runs for, you know, 4-to-1, 5-to-1 ratio. It washes out all those losses. And that's what keeps you in the game, and that's what helps you grow your account exponentially. All right? Little Yamaki. But I'm going to give you your day back now. Like I said, we'll talk soon. You guys have a great weekend. Thank you for everything, all right?
Appreciate it. Thank you.
Yeah, no problem.